Welcome to the Deep Dive. We're tackling IRS Publication 519 today, specifically for your 2024 U.S. tax returns if you're not a U.S. citizen. It's dense stuff.
It really is. And honestly, getting this right from the start is critical. We're digging into the rules that define your tax life here.
Exactly. Our whole goal today is figuring out that big question. Are you a resident alien, an RA, or a non-resident alien NRA? Because, well, everything flows from that.
It absolutely does. Get classified as an RA, and you're basically taxed like a U.S. citizen on your income from everywhere, worldwide. But if you're an NRA, it's different. You're generally only taxed on U.S. source income or income that's, effectively connected to a U.S. business. Getting that status right is step one, non-negotiable.
Okay, so let's lay the groundwork. How does the IRS make that call? Pub 519 gives us two main ways to be an RA. The first one seems simple enough, the green card test.
Yep. Lawful permanent resident status. If you have a green card, you pass this test. Pretty straightforward.
Yeah. But the second one, that's the substantial presence test. This sounds like where the real counting happens.
That's the one. It causes the most headaches, for sure. For 2024, you need to hit 2 marks. First, you got to be physically in the U.S. for at least 31 days during 2024 itself.
Just 31 days in the year, okay.
But wait, there's more. Part 2 is the big one. You also need a total of 183 days of presence over a 3-year period, 2024, 2023, and 2022. And it's not just adding them up.
Right, there's that weighted formula involved. How does that actually work? Why do they do it that way?
Well, the idea is to see if you have a consistent pattern of being here. So they count all your days in 2024, 100%.
Okay.
Then for 2023, they only count 1/3 of the days you were present.
1/3?
And for 2022, it's even less, just 1/6 of those days. You add up those weighted days from the 3 years. If the total hits 183 and you met the 31-day rule for 2024, boom, you're considered a resident alien under this test.
Okay, here's where I think people really get caught out. Not every single day you're physically standing on U.S. soil counts towards that 183-day total, right? There are exceptions.
Absolutely, critical point. Yes, there are specific days the law says you don't count even if you were here. And missing these exclusions can push you over the limit unexpectedly.
Like commuters, people living in Canada or Mexico and working here.
Exactly. The publication's quite specific. If you regularly commute from Canada or Mexico to work in the U.S., and regularly means on more than 75% of your work days during that period, those commuting days don't count towards substantial presence.
That 75% is the magic number then. You mentioned the Maria Perez example.
All right. So Maria commuted 69 days out of her 76 work days. That's... let me check. Yeah, 90.8%. Since that's way over 75%, all 69 of those days excluded, wiped from the count. That can make a huge difference.
Wow, what other days get excluded?
Well, there's time spent just passing through less than 24 hours in transit between 2 foreign places, as long as you're not really doing business here. Also, days as a regular crew member on a foreign ship.
And the medical one, if you get stuck here because you got sick.
Yes, that's important. If you intended to leave but couldn't because of a medical condition that started while you were already in the U.S., those days generally don't count. But, and this is crucial,
There's always a but with the IRS.
you have to file Form 8843, the statement for exempt individuals and individuals with a medical condition. If you don't file that form properly filled out, those sick days count, period.
Form 8843. That seems to pop up a lot. It's also key for exempt individuals, isn't it? And that term itself can be confusing.
Very confusing. Let's be super clear. Exempt individual does not mean exempt from U.S. tax. It just means the days you're present in the U.S. under that specific status are exempt from being counted for the substantial presence test. That's it.
Okay, so who falls into these exempt categories for day counting purposes?
Primarily, you're looking at foreign government folks, A or G visa holders, but not their A3 or G5 household staff. That's an important distinction. Then you have teachers and trainees on J or Q visas.
And students?
Students, yes. F, J, M, or Q visas. They can be here for years sometimes, but if they maintain their student status correctly, those days don't add up towards the 183-day test. Professional athletes and certain charity events, too.
But for the students, just like the medical issue.
Form 8843 again. They must file it every single year they want to exclude those days. No form, the days count. It's a hassle, but it's the rule.
It really sounds like the paperwork is almost as important as the facts on the ground sometimes.
You could say that's often the case with tax compliance, yes.
Okay, hang on. Let's say I do meet the substantial presence test based on the weighted days. But maybe I wasn't actually here for most of this year, 2024. Is there an escape hatch? the closer connection exception.
Yes, there is, but it's got strict conditions. This exception only works if you were physically present in the U.S. for fewer than 183 days in the calendar year 2024 itself.
Okay, so less than half the year in 2024.
Right. Even if the 3-year weighted total hits 183, if your 2024 presence is under 183 days, you can argue you're still an NRA. But you need to prove 2 things.
Worry.
First, you have to maintain a tax home in a foreign country. And remember, tax home generally means your main place of business or work, not necessarily where your family lives.
Got it. And second,
you need to show you have a closer connection overall to that foreign country than to the U.S. Think about things like where your family is, where you vote, bank accounts, driver's license, social ties, that sort of thing.
and I assume there's a form for this too.
Of course.
Oh.
Form 8840, Closer Connection Exception Statement. You have to file it on time with your tax return. If you file late, the IRS usually just says, nope, you can't claim the exception.
Ouch. Okay, let's shift gears to a common situation. Arrival or departure years. The dual status alien. You're an NRA for part of the year, then become an RA, or vice versa.
Right. And being dual status in 1 year? Well, it brings some significant filing limitations. It's not the best of both worlds, unfortunately.
Let's drill down on that. What are the big financial drawbacks of being dual status? What benefits do you lose?
The big one is the standard deduction. Dual status taxpayers cannot claim it.
Wow. That's huge for most people. Tens of thousands of dollars potentially untaxed.
Exactly. So unless you have enough expenses to itemize things like state taxes, mortgage interest, big charitable gifts, losing the standard deduction means your taxable income jumps up significantly just because you're in this transition year.
That feels like a penalty just for moving. What else?
You also generally can't use the head of household filing status, which has better tax brackets. And critically, you usually can't file a joint return with your spouse.
No joint return.
Unless you make a special election to treat your spouse, even if they were an NRA for the whole year, as a U.S. resident for the entire tax year. That lets you file jointly, but then their worldwide income might become taxable too. It's a whole separate calculation and decision.
Okay, so when does your residency actually start if you arrive mid-year and meet, say, the substantial presence test? Is it day 1?
Generally, yes. It's the first day you were physically present in the U.S. During the year you meet either the green card or the substantial presence test. But there is a small exception.
Ah, a small break.
A small one. You can potentially ignore up to 10 de minimis days of presence. Say you popped over for a quick visit earlier in the year before your main move. If you can show you still had a closer connection to your foreign home country during those brief 10 days or fewer, you can exclude them from starting your residency period.
And how do you claim that?
You guessed it, you have to attach a specific statement to your tax return explaining why those days should be excluded under the de minimis rule.
All right, phase 3. We've figured out the status RA, NRA, or maybe dual status. Now, how does the IRS figure out what income to tax, especially for NRAs? Let's talk sourcing. Personal services, wages. What's the basic rule?
It's location, location, location. If you perform personal services while physically in the United States, the pay you get for that work is generally U.S. source income. Doesn't matter if your boss is in London or Tokyo, or if the money lands in a Swiss bank account. If the work happened here, it's U.S. source.
Okay. But what if I work for one company, say consulting, and I spend some weeks working in the U.S. and some weeks working abroad?
That's where you need the time basis formula. You have to allocate your total compensation based on work days. You figure out how many days you worked in the U.S. during the period the pay covers, divide that by the total number of days you worked everywhere during that same period, and multiply that fraction by your total pay.
Can we use that Christina Brooks example from the publication?
Sure. So Christina gets an $80,000 salary. She worked a total of 240 days in the year, but only 60 of those days were physically worked inside the U.S.
Okay.
So you take the U.S. work days, 60, divide by total work days, 240. That gives you 1/4, or 0.25. Multiply her $80,000 salary by 0.25.
20,000.
Exactly. $20,000 of her salary is U.S. source income, subject to U.S. tax. The other $60,000 isn't, based on this rule.
Got it. So once an NRA calculates their U.S. source income, it gets taxed in one of two main ways, right? What's the first category? ECI.
Right. Effectively connected income, or ECI. This is income that's closely tied to a U.S. trade or business. Performing personal services here working typically generates ECI.
And how is ECI taxed?
The good news relatively speaking, is that ECI is taxed at the same graduated rates that apply to U.S. citizens and residents. Plus, you can take deductions related to generating that income.
Okay, so deductions are allowed against ECI.
Yes. And an interesting point sometimes overlooked is pensions. If you get pension payments later when you're an NRA, but those payments are linked to work you did in the U.S. after 1986, that pension interim can still be treated as ECI.
That's a long reach back. What's the second tax bucket for NRAs? The one that sounds less friendly.
That's the tax on FTAP income. Stands for fixed, determinable annual or periodical income. Think things like U.S. source dividends, interest, royalties, rent, if it's not ECI.
And how does that get taxed?
It's hit with a flat 30% tax rate right off the top. Or maybe a lower rate if a tax treaty applies. But here's the kicker. You get 0 deductions against FTP income. None. The 30% or treaty rate applies to the gross amount.
Wow, 30% flat, no deductions? That's steep. Okay, speaking of tough rules, we absolutely have to talk about the $3,000 tripwire for NRAs working here temporarily for a foreign employer.
Oh yeah, this one is brutal. It's incredibly sharp if you're an NRA working briefly in the U.S. for a foreign company or person.
Okay, foreign employer is key.
Absolutely. The pay you get for those services can be completely exempt from U.S. tax if 2 conditions: you're present in the U.S. for 90 days or less during the tax year, and your total pay for those services is $3,000 or less.
Both conditions have to be met. 90 days or less and $3,000 or less. So what happens if you earn, say, $3,000 or less? Just the extra dollar is taxed.
Not a chance. If your pay hits $3,001, the entire $3,001 loses the exemption. It all becomes taxable U.S. source ECI.
The whole amount, just for crossing by $1.
The whole amount. That's why we call it a tripwire. One step over the line, and the whole benefit vanishes. It's a massive cliff effect.
That is genuinely shocking. A very expensive dollar. What about things like scholarships or grants for NRAs? How are they sourced?
Generally, the source follows the residence of the payer, so a scholarship from a U.S. university, usually U.S. source.
Okay.
But there's an important exception. If the grant or scholarship is for activities that will be performed entirely outside the U.S., then it's not U.S. source income, even if the payer is American.
Okay, that makes sense. Let's move into Phase 4. Deductions, treaties, and filing details. Treaties seem super important here.
They are absolutely essential, covered in Chapter 9 of Pub 519. Tax treaties between the U.S. and other countries can override many of the standard U.S. tax rules we've been discussing. They can offer lower tax rates, like on that 30% FDAP tax for dividends, or even complete exemptions for certain types of income.
But if you use a treaty to get a better deal than the U.S. tax code offers, you have to tell the IRS, right?
You definitely do. If you claim a treaty position that overrides or modifies an internal revenue code provision and it actually reduces your tax, you generally have to file Form 8833, Treaty-Based Return Position Disclosure. You can't just quietly take the benefit. You have to formally disclose it.
Okay, Form 8833 for treaty benefits. Now, we mentioned NRAs generally can't take the standard deduction, but there's one very specific, surprising exception tucked away. Who gets this special treatment?
It's really unique. Non-resident alien students and business apprentices who are from India and are eligible for benefits under Article 21(2) of the U.S.-India Tax Treaty. They get a choice. They can choose to take the standard deduction instead of itemizing their deductions.
Just students and apprentices from India. That's incredibly specific. Yeah. Why is highlighting that one rule so important for everyone listening, even if they're not from India?
Because it proves the point that the general rules have exceptions, sometimes very valuable ones, hidden in specific treaties. The default is no standard deduction for NRAs. But here's India with this huge potential tax break carved out just for their eligible students and apprentices. It tells every NRA listening, don't assume the default rules apply to you without checking your specific country's treaty very carefully. There might be gold hidden in there.
Good advice. Check your treaty. Okay, quick logistics wrap up. What form do NRAs file and when is it due?
NRAs file Form 1040-NR. The deadline depends. If you're an employee and had U.S. wages subject to withholding, it's the usual tax day, April 15th.
And if not, if you just had, say, FDAP income with tax withheld?
Then you get a bit longer. The deadline is June 15th, actually June 16th in 2025 because the 15th is a Sunday.
Okay, April 15th or June 16th. And one final, often forgotten step for people leaving the U.S., the sailing permit.
Ah, yes, the Certificate of Compliance or sailing permit. Before most aliens physically depart the U.S. for good, or even for an extended period, they technically need to settle their tax accounts. This usually means filing Form 1040-C, the departing alien income tax return, or maybe the simpler Form 2063 statement.
So you have to sort of tax clear before you leave.
In many cases, yes. You often need to go to an IRS office. There are exceptions, of course, for tourists, certain students, trainees, but many people who've worked here need to get this compliance certificate before heading out.
We've covered a ton of ground. Day counting, the brutal $3,000 cliff, ECI versus FDAP, forms like 8843 and 8840, but it all comes back to that initial status determination. Resident alien or non-resident alien?
Absolutely. That status drives everything. And, the significance of that status, particularly residency, doesn't just end when you leave the U.S.
What do you mean?
Well, think about someone who is here for a long time, maybe a green card holder for, say, 8 out of the last 15 years. They're considered a long-term resident, an LTR. When they give up their green card or otherwise expatriate, the IRS has one last potential bite under Section 877A, the expatriation tax.
Expatriation tax. That sounds serious.
It is. If you're an LTR or a former U.S. citizen and you meet certain wealth or tax liability thresholds when you leave, like having an average income tax over roughly $201,000 for the prior 5 years, or a net worth of $2 million or more, you get labeled a covered expatriate.
Okay, covered expatriate.
And the consequence?
The consequence is a potential mark-to-market tax. Essentially, the IRS treats almost all your worldwide assets, stocks, property, everything, as if you sold them for their fair market value on the day before you officially cut ties with the U.S.
Wow. So you could owe a huge amount of tax on theoretical gains just for leaving.
Exactly. You pay tax on the appreciation as if you'd sold everything, even if you haven't. It could be a massive, unexpected tax bill right at the point of departure. That mark-to-market rule really hammers home how seriously the U.S. views the tax implications of residency, even when it ends. A very heavy price for breaking that connection.
It certainly is. It's a final, potent reminder of why understanding your status and its long-term consequences is so incredibly important.
So whether you're just arriving, deep in your work or studies here, or planning your exit, getting your U.S. tax status right, RA or NRA, is foundational. Use what we talked about today from Pub 519 as a starting point. Dig into your specific visa, check your country's tax treaty, and know those crucial forms 8843, 8840, 8833, 1040C. Because honestly, in this system, knowing the rules is your best protection.